Well, good evening and welcome to tonight's webcast of Understanding Collections and Financial Reports. I'm Ralph Troiano. I'll be your guide tonight through this really interesting topic. This is, as you know, part of our C.I.A. Services seminar series, and this is actually the 14th year that we've been doing this, so we're real pleased to be presenting it. Our goal has always been to be able to present information to our very valuable volunteers to make them more comfortable in the knowledge of what their association and their responsibilities are all about, and also to make them comfortable in the decision making of everything that comes before them. We like to, for anyone who's been to any of our seminars, you know that we really like to present information in a very practical manner, a way that you can immediately put to use the information that you received tonight. This year, we've moved, as all of you obviously know, we moved to a webcast format. Our whole objective here is to try to get the word out and make it a little easier for people to become part of our seminars and get the information that we provide. So we're real excited about that. You can connect from the comfort of your home. One of our folks has already chatted to us that he's got some nice pizza sitting with him. And you can connect in any format you want. So whether it's a smartphone or a tablet or a laptop or your desktop, whatever you prefer. One of the things that we're excited about and we hope to be able to do is this. Not everyone can make it tonight. Some have other conflicts. And so we're recording this webcast as we did the last one, and we're looking to be able to make it available to anyone, anytime, to be able to see this. Now, interaction has always been an important part of our seminar series, where you get to ask questions that are important to you. And we want you to do that throughout this webinar. So if you'll go ahead and just type your questions into the chat box, then we'll be able to answer them. I'd like to introduce two people here who are helping out tonight. And so first of all, coming towards me, we have Tina Jameson. Tina Jameson is the branch manager of both our Bandera and San Antonio offices. She is an executive vice president with C.I.A. Services and one of our founders. She'll be helping out in the control room as soon as she steps out of here, making sure everything is working on the technical end. Also is Kim Moore. Kim Moore is a vice president of C.I.A. Services, and she manages our Southwest office. Kim is going to be the one who'll be receiving your questions. In some cases, she'll chat the answer back to the group. In other cases, she'll be asking the questions so everyone can hear them. So thank you very much. What we'd like to do at this point is go ahead and look at the agenda. So on your agenda, you'll see that we are going to talk about the collections process. We'll talk about the legal end of collections, and we'll go into that not in a great amount of detail. That's something we actually cover in one of our sessions called Advanced Topics for Board Members. But we'll be covering the legal end of collections. We'll talk about what things put collections on hold and what we do while particular accounts are on hold. There's a whole lot of other collection issues we'll touch on, and then we'll go into the financial reports. One of the things that's kind of interesting is the way we can trace the flow of money and transactions that are on your financial reports that you receive every month. So let's go ahead and get started. Let's start on the collections process. It all starts with setting a budget. And so ideally, in a perfect world, we would set the budget, set the assessment, the board of directors would do that. We'd send statements to every single owner. Every single owner would send in a check on time, and we'd be done. That would be it. Unfortunately, it's not a perfect world, and for a variety of reasons, all of the funds don't come in by the due date. And that's where we go through the delinquent collections process. That's a majority of what we'll be talking about tonight, what the process is and what we go through. And so there are groups of things that we do. At the management company, we send past due statements, we file liens, we enter into payment plans. Potentially, in some cases, we're withholding privileges from owners, the right to use the swimming pool or get keys to the tennis courts or things like that. Once all efforts have been exhausted at the management company level, at that point it goes to a legal status and the attorney gets involved. The attorney may send demand letters, might file a lawsuit, may actually go to court and get a judgment. If we go through all those steps and we have a judgment and the owner still has not paid, then we can go through post-judgment remedies. We have a judgment, but we still don't have any money in our hands, so what do? Those are post-judgment remedies that we'll talk about. Now, the standard collections procedure that we go through is part of the C.I.A. Services Management Contract. It's Exhibit D, and that'll describe all of the steps we're going to go through. I'm going to summarize those just in a moment, but you can read all the details there. So let's move on to the next slide and talk about what the typical steps are that we go through. Every one of these steps can go off in another direction depending on a response by a homeowner, but we'll go through what typically happens if a homeowner doesn't pay at any particular point in the process. To make it simple, we're only going to talk about the process for annual assessments, where we send the assessments out. They're due on January 1st. There's a very similar process if a community has semi-annual assessments, quarterly assessments, every 2-month assessments, or monthly assessments. It's a similar process. Some of the criteria for moving to the next steps are different. So we're going to stick with an annual process so you'll get the big picture. The first thing that happens in the fall time frame, no later than November, hopefully in September, maybe in October, and certainly no later than November, the budgets are prepared, presented to the board. The board of directors sets an assessment and adopts the budget. That's the start of the collections process. As soon as that's done, we send out, the management company sends out an assessment letter, statement, and a variety of other things to every owner in the community. That notifies the owners that the assessment is a certain dollar amount. It provides them with information about how those dollars are going to be used. At this point, I'd just like to point out that one of the items you got in advance, in addition to the slides you're looking at, we sent a copy of a large number of samples. I think there's 37 pages worth of information here. So many of these things you'll see sample annual assessment letters, past due letters, liens, bankruptcies, all sorts of stuff are in here that you can refer to at another time. On a variety of these slides, we have the word sample after a particular line item. That just tells you can go into that package and see what we're doing at those steps, real life examples. So after the budget's been set, after we've sent out an annual notice to everyone, there's a due date on that. That notice goes out right after the board adopts the budget. Everything on an annual assessment in this example is due on January 1st. Almost all associations have a 30-day grace period. In other words, it's due on January 1st, but it's not overdue until after January 31st. And so the first delinquent collection step occurs in February, where we send out a past due notice. If there's no response to that, In March, a month later, we send out a past due notice by certified mail. So it's a certified letter with a statement that has certain wording in there as required by the Texas Property Code. If that doesn't work, in April, we're filing liens on properties. Every one of these steps lets the owner know what the next step is. So for example, in that certified notice that we sent out in March, it indicates that if the assessment is not paid by this date or you have not gotten on a payment plan, that in April we will file a lien and there will be a cost associated with it. So part of good communication is ensuring that we let people know our expectations. Please pay this dollar amount by this date. And if you don't, what the ramifications are. We will file a lien. There will be a $190 fee on your account. It will affect your credit. And so that is good communications. It's professional and it's reality. So we want people to know what their options are. In all cases, we're offering them payment plans if they have extenuating circumstances and things of that sort. So once we file a lien, and again, this whole example is the owner not responding at all. Once we file a lien, as soon as we get the lien back from the county, we send a copy of that officially stamped and recorded lien to the owner with a letter saying, here's the lien we said we were going to file, here's the next step, please get on a payment plan or make arrangements to pay. If the lien doesn't work, if the copy of the lien that they physically are now holding in their hand with the official stamp on it, if that doesn't work, the next step is for us to go to the board of directors and recommend to the board that this account be turned over to the association's attorney for a demand letter. In our collections process, there are two steps that we come to the board and ask for permission. This is the first step. Everything up until that point, the past due letters, certified letters, the liens, are all done automatically without the board having to make decisions on a case-by-case basis on those. But when we come to the board and say we want to turn this over to the attorney, that means the association is going to be spending some money and the board needs to be making that decision. So we come to the board says yes, go to the attorney, or no, don't go to the attorney. The board makes that decision. The attorney sends a demand letter out. Hopefully that works. There's some things we do in working with the attorney to attempt to come up with a settlement with the owner or payments from the owner. If that still doesn't work, we come back to the board a second time. The second time we come back and say nothing worked, we recommend that a lawsuit be filed against these owners. The board again makes that decision. If so, a lawsuit would be filed. Once a lawsuit is filed, there's all sorts of ways that the collection process can go. And so come to our advanced topics for board members and we can learn about those. So that's the general case. Let's go into specifics. So on the next slide here, let's talk about the very first step, setting the assessment. Well, the whole setting the assessment step starts with our budgeting process. As you know, at C.I.A. Services, we refer to our budget model as our super budget. We actually are starting next month in our accounting office preparing the initial setup of the 2018 budget. So it actually starts in our office in April. At the end of July is when our community managers become involved and start preparing the initial drafts. And sometime, typically in September or October, the board of directors is seeing the first draft of the 2018 budget. So the super budget, what's special about that is it doesn't just look at the operating revenues and expenses. It looks at those. It looks at projects that we might be doing. It considers the long-term reserve requirements for the association. Reserves are funds that we put aside for future use. So for example, we put aside money for replastering the pool every 8 to 12 years. And when we do that, we take it out of that reserve. I'll get into that fund accounting in just near the end when we're talking about financial reports. So we're considering revenues and expenses, project reserve requirements. We're looking at if there are particular goals for a community, that we have this wonderful park that has nothing on it, and we might want to put a walking trail in. We might want to put some playground equipment. We may want to put a nice brick wall around a portion of it. Those are future goals for things we don't have yet. That also gets worked into a super budget. So we do this long-term forecast. We determine what the ideal amount of money we ought to have sitting aside in the reserve accounts in our banks. And with that, once we have all of those obligations, we're then able to calculate the very last number, which is what is the right assessment for this association with these assets and these goals. And we calculate that. That's what's presented to the board of directors, the whole super budget package. Once the board of directors has reviewed the budget, made any changes, adopted the budget, and set the assessment, then we can go on to the next step. I indicated that our calculations come up with what the assessment ought to be. And if it's a small increase or it's at the right level already, that's an easy decision generally for the board. However, sometimes a set of governing documents might have limitations. They might have a maximum increase that is small. We may come back and think that we really need a 5% increase, but if the CC&Rs, covenants, conditions, and restrictions, your governing documents, indicate that the maximum increase is 3%, then that's all what we need to live with is the 3%. So we always need to consider what the documents say. What is the maximum we can increase without a vote of the membership? What if we really need to go above what is needed? How do we get that vote of the membership? In a community that we have in San Antonio, we recently helped the board understand that the board had authority to raise the assessment $0. In fact, their authority was, if you keep it the same, you don't need a vote. Amazingly, if they wanted to drop the assessment, they would need a vote of the members. And so we had to increase our assessment, and there's a process in the governing documents which indicates what kind of a vote of the membership is required. So if you face that, then we go down that road if it's necessary. Both of those are achievable. Either an allowed increase by the board of directors or, if necessary, a vote of the members. There's also something that applies in a limited number of counties in Texas. And those counties are all in the greater Houston area. And that's something called Chapter 204 of the Texas Property Code. 204 was one of the early chapters that was written that really helped associations. But in order to get it passed, the legislators who were introducing the bill bracketed the bill just to a small group of counties. That way, the affected counties in the greater Houston area, they were very supportive of it. Those elected officials voted for it. By not including the whole state, they didn't have to try to convince all of the other elected officials that this was good. So it's highly bracketed to the Houston area. What it says is it puts into law the ability to do what's called accumulate increases. So, for example, if your association has written into the CC&Rs the ability to raise the assessment by 3% per year, and this year the board says, no, we don't need to raise it. And they say that 2 years in a row, we don't need to raise it again. In that third year, under this law, the board could raise it 3, 6, 9% in that third year. So that's what's called cumulative increases under Texas Property Code Section 204. Again, it only applies in the greater Houston area. There was, and I'll just point this out very quickly for the folks who are joining us from Houston, a few years after that law was passed, there was a Texas Appeals Court ruling in 2004. It was Brooks versus North Glen, and that lawsuit limited the applicability of what I just talked about. You have to have some very specific language in your documents for even that state law to apply. So it's not a fix-all, but in many cases it will help associations who need to go up a little bit more than the percentage shown in their CC&Rs. There are some other associations which have what we've referred to as a hard cap. A hard cap is where your deed restrictions say the assessment is $60, period, providing no mechanism to increase that number. The only way to increase it is by actually amending your whole set of deed restrictions. And one of the stories I really enjoy telling folks about this particular issue is one of our communities in Simonton, Texas, called Valley Lodge. Valley Lodge is a really nice community. It's right on the Brazos River, which is the other side of the issue, in that it's in an area where the Brazos would flood, and unfortunately last year the whole community was underwater. But Valley Lodge has some large lots in it, and way back when it was developed in the late 1950s, I believe it was, Simonton was a long way from Houston. It's still a long way from Houston, but there are great roads that get you out there now. And Valley Lodge was known as a ranchette community because it had lots that were bigger than the tiny lots in the urban part of Houston. So they were half-acre to, in some cases, a couple-acre size lots. They encouraged having horses out there. They had bridle trails originally. And Valley Lodge had a hard cap of $60 assessments, which back in the 50s was wonderful. But as we move forward in time, $60 doesn't do too much. What's really interesting also about that particular assessment is Valley Lodge had the Valley Lodge Country Club, which was a country club, a very kind of rural type country club, but a country club with a golf course. And your $60 bought you your membership in the country club. So that $60 really went a long way back in the 50s when it was first developed. But back to the point of hard caps. What can you do if your restrictions say your assessment can only be $100, $200, $60, whatever it is? Well, there are several things that can be done. You want to be able to have the funds to operate your community, and prices do go up over time. So you have a couple options. The Valley Lodge option was to amend their CC&Rs. It was a large effort, but they were able to amend their CC&Rs in 2/3 of the community. That's another story, but they were able to amend their CC&Rs. And now their assessments are up to almost $80. It hasn't changed too much, but they got the additional funds they needed to accomplish the things that the residents of the community wanted. Another option is to provide a special service assessment. This is provided for in Texas Property Code Section 204. So specifically, it definitely is allowed there, but we have seen, and it's been supported, that you can use that same thing in other areas. You'll always want to check with your attorney about this before you do it, but it is specifically enabled under Section 204. And what a special service assessment is this? You can break out a particular service and say that this service, I'll give you examples in a moment, is in addition to the things that are taken care of by the normal general assessment. So let's say you have a cap, as we do in one of our communities, Oak Cliff Place. Let's say you have a hard cap of, I believe, around $120 is what their hard cap is. Again, that was great 30 years ago. Today it's not so great. What they've done is they have a special service assessment for the street lights that have to be paid for there. They have a patrol service and things of that sort. So they take the $120, pay for everything else, and then bill everyone $20, let's say, whatever the number is, for the security patrol, and $30 for the street light. And so the end result is, in that example, they have $120 general, plus $20 for the security patrol, plus $30. So they're actually collecting $170 from owners by taking advantage of that approach. Again, it's provided under state law in the Harris County area, the Houston area. In other places, you're absolutely going to want to check with your attorney about your attorney's comfort level with using that. Voluntary assessments, that's another option. We have a number of communities who have voluntary assessments. Indian Shores is one of them. Indian Shores was built around the same time as Valley Lodge. Indian Shores has a $60 cap on their assessments. It's a beautiful community right on Lake Houston. They have a voluntary assessment that provides for trash service, provides for mosquito fogging, and provides for security in the community. And the vast majority of residents pay that voluntary assessment. You can shift expenses to other entities. That is a really good approach that everyone ought to consider and take advantage of if it's available, because it helps reduce your assessment. So how could you shift expenses to other entities? Well, there's a couple ways. One thing that happens automatically is if a community, for example, is in an unincorporated area, it's in a county area, not part of a city, then that community most likely is paying for streetlights, paying for trash service, paying for a couple services that if you were in the city would be providing it through your tax dollars. And so when a community is annexed into a city, those costs would typically go away. The association would no longer have to pay for those services. So that happens without you doing anything. But how many cases are there that you have a city that is about to gobble you up where you can have that benefit? Prior to that, there are some things that you can shift. And there's an entity that's more popular in the Houston area than it is in San Antonio, a little bit in the Austin area, and that is utility districts. We don't see them much in San Antonio. We see them all the time in Houston. And utility districts are the ones who provide the water and sewer and some other services, but specifically a municipal utility district is the one who provides water and sewerage treatment. Under state law, those entities, those municipal utility districts and similar districts like them, have a right to provide park services, provide a whole variety of services to the citizens of that district. Your homeowners might be part of that district. And so we have a lot of cases where, by a simple petition to the utility district, we're able to get the utility district to take over trash service, and they'll pay for it. Or as a minimum, they'll take it over and bill the homeowners for it, but it comes out of the HOA budget. They will pay for streetlights. They will pay for maintaining parks that are available to citizens of the district. They will pay for security patrols. In some cases, they'll pay for improvements to facilities. And so that is a wonderful way to shift expenses from your HOA assessment over to a municipal utility district or something similar to that. And then finally, the last thing that we always should be thinking about is how we can be more efficient with our expenditures. Are there opportunities for reducing costs? So that's the whole part about assessments. We try to set it by what the budget says, but we may have limitations as we've just described here. Once we've gone ahead and set the assessment, we send the mail out. That has to happen. Your governing documents will indicate this, the exact timing, but it almost always says that owners must be notified at least 30 days in advance of the assessment period, which would mean if you have an annual assessment where things are due on January 1st, then by specifically December 1st, you must have notified, have sent them something that indicates what the assessment is and what they owe. The typical due dates are 30 days, are January 1st, with a grace period of 30 days before there are any penalties. In other words, before interest and other things are applied. If a community has semi-annual assessments, then it's typically January 1st, July 1st. If it's quarterly, January, April, July, and October. So whatever mail out goes out is based on what the due dates are. In the samples I sent you, we have the whole group of what goes out. There's a nice cover letter that says, hey, this is your assessment, here are your options. This is a little bit about how your assessment is going to be used. It includes a copy of the operating budget for the next year, a statement, multi-payment coupons, I'll talk about those later, and then a return envelope or return envelopes to the lockbox address. So I've introduced a new term. What is a lockbox? A lockbox is physically a post office box that is associated with a processing center. So anytime you guys are paying your credit card bills, your gasoline card bills, any of those things, you mail your statement, you mail your check to a lockbox processing center. That's what C.I.A. Services uses. We use a lockbox processing center at Mutual of Omaha Bank. That's why all of your operating bank accounts are at Mutual of Omaha, because that's where the funds go. It works this way. The payments from owners go to a post office box in Phoenix, Arizona. That post office box is a C.I.A. Services post office box. Nothing else goes into that box except checks for clients of C.I.A. Services. Every morning, very early in the morning, the bank sends a big truck, a van over to that post office and goes into our post office box, grabs everything, puts it in a container, and there are a couple other management companies around, and so they also pick up their mail and payments and put them in their own little containers. They bring it all back to the Mutual of Omaha processing facility, puts it through some really amazing equipment that scans all the checks, reads what's on the checks, and puts that money that day, the same day it arrived at the post office, puts it in your bank account, your association bank account. That evening, they send us information that says, we received a check from John Doe on this account for $150. So they send us all that information electronically about what happened yesterday and what got put into your bank account. There are some cases where the bank can't figure out what this is. And that sometimes happens if someone sends a check without a coupon. They do have a way of reading the information on there, and with data we give them, figuring out, oh, that's John Smith at this address and he lives in this community. So they handle a large portion of those exceptions, in other words, the ones that don't come back with a coupon. But if there's one they just can't figure out, then they send us the next day a picture of that check and anything else that came back with it, maybe a coupon that was, torn in half or whatever else. They send it to us, and then we're able to almost always identify it by a phone number on the check, by an address, by a name, by something on there. We're able to identify it. We just tell the bank, and they process it for us. They get it in your bank account. The nice thing about the lockbox processing at Mutual of Omaha Bank, and while we partnered with them for probably at least 10 years now, is there are no fees associated with this service, this lockbox service, so you're not paying anything for it. There's no fees on your bank statement for this processing, and it's an interest-bearing account. So they're still paying you a tiny amount of interest, since interest is bad, except it just went up. And so that's one of the benefits of the arrangements we have with Mutual of Omaha Bank. Okay, so let's get back to the process. The statements went out, or excuse me, the budget was set, the statements went out, someone still didn't pay, it's now February. It's time for us to send out a past due statement. We generally refer to this as the pink slip statement internally, because we literally put a colored sheet of paper in with the statement that indicates that your payment is overdue, a late fee has been added to your account, please pay or get on a payment plan, here's how you can get on a payment plan. We do this if it was overdue after January 31st, we still wait 3 to 4 to 5 days before we send out this pink slip notice, this past due statement. And the reason is, even though it clearly was due January 1st, some owners think, well, I got 30 days to do it, so let me mail it on the 31st of January. And then they would argue, generally unsuccessfully, but they would argue that, well, it was postmarked then, and it's the post office's fault that you didn't get it. And so by putting that additional 3 to 5 day buffer in there, we avoid those sort of complaints from homeowners or trying to convince us that 30 days past the due date wasn't enough, that they needed more. So they end up getting 33 to 35 days. On the last day of every month, we do apply interest, and that interest is based on whatever the rate is in your CC&Rs. Anything from a very small number, the smallest number I think I've seen is in the range of 6%, may have seen a 5%, all the way up to 18%. And then some say at the highest rate allowed by law. And when it says that, the rate allowed by law actually varies over time. There's a benchmark that it's tied to, and so we'll typically be using a lower number, but I won't get into the legal reason we do that. But in any case, interest is applied. It's applied on the last day of the month on the unpaid interest-bearing invoices. What does that mean? Well, most restrictions say you can charge interest on unpaid assessments. Great. Very few say that you can charge interest on anything that's overdue. So for example, once you put interest on it, in some cases you can charge interest on that interest. Or if there's a late fee, you can charge interest on the interest and the late fee and the assessment. So it depends on what it says. That's how we have things set up for applying the interest. The first late fee, as I mentioned, is applied. With C.I.A. services, it's a $40 late fee, and that's one of our administrative fees that I'll be talking about later. When collected, when that $40 is paid, $20 comes to C.I.A. services, and $20 is retained by the association to offset the association's costs. This past due notice is sent by regular first-class mail. It includes the pink slip, the statement, and another return envelope. If that still doesn't work, now we're getting into the certified statements. Now we're getting a little bit more serious here. This happens in March. We typically are waiting 3 to 7 business days in this case as an additional grace period. In February, we ask them to pay or get on a payment plan by February 28th. So we'll wait approximately a week into March before we send these certified statements. The interest is applied. Our second late fee on an annual assessment basis is a $60 late fee. Again, it's split 50-50 when paid. We send this by certified mail, and if it comes back to us unclaimed, at that point we will resend it by regular mail to the owner saying, here's what you did not claim. So there could be a delay before they get the actual statement there. It has all of the things we described before, return envelope, a statement, but in addition, the letter has some specific Texas Property Code required language that must be sent by certified mail at some point in the delinquent collections process. We do it at this point since we're sending this particular one by certified mail. It has 2 specific things that are stated. One is to give them official notification that if this must go to an attorney, that we will charge back reasonable attorney fees to their account. That's required that we notify them of that. And secondly, there's a notice of rights for people who may be in active military duty. We don't know who is, so that notice actually goes to everyone that says if you are active, you have certain rights under the Service Members Relief Act, the federal act. All right, if that still doesn't work, it's time for a lien. We apply liens typically once a year, and that's in the mid-April time frame. However, throughout the year, we may be filing liens that didn't get filed in April. For example, if someone gets on a payment plan early on and then they eventually void the payment plan, they don't make their payments, then they would be on a slightly delayed cycle because we gave them a short-term relief, but we then picked it up later on when they voided their payment plan. So throughout the year we may be filing them. If a closing is going to occur and there is something where we need to assist in the closing, we may delay a lien. In a moment we'll talk about what we'll do if we need to release a lien. What sort of criteria do we use? Well, only if the assessment hasn't been paid. So if there is a bunch of late fees and legal fees and DR fines, we're not filing liens on those things. And there's reasons I won't get into, but the law is clear on what sort of things you ought to be proceeding on. If they're on a payment plan, we don't file a lien. If they're in bankruptcy, we don't file a lien. So there needs to be an unpaid balance of some significant amount. When it's time to file that lien, we go ahead and put on the account a fee. The fee that we put on the account is $190. I'm going to talk about that in a minute because it's part of our administrative fee recovery program, which is really good for associations. So we add that to the account, we send all the lien data electronically over to a specific attorney. The documents get printed, signed by the attorney, filed electronically with the county, and then once we get the lien back, we mail it on to the owner. When I said we send it to a specific attorney, every association, you have an attorney that you work with. In most cases, in almost all cases, we are not sending that lien data to the association's attorney, and there's a really good reason for this. We use a law firm of Barcelo and Associates for filing all the liens and all the releases for all of our client communities. Clearly, there's a volume discount by doing that. We have set up the electronic communication with that law firm so that it's very efficient for them to file the liens versus if the liens are being done on a one-by-one basis by the association's attorney. Because of all that, the chargeback to the owner is only $190 for both preparing and filing the lien, preparing and filing the release. If this were going through the association's attorney for, let's say, a single lien, the cost to the association may be $250 for that first, for applying the lien, and maybe $150 for the release. That's $400. That would all get charged back to that owner account. And so by using this efficient electronic transfer of data, bulk filing and preparation, we're able to keep the cost down for that owner. You might say, well, who cares? They haven't paid their assessments, and so they deserve a large amount. Well, the fact that they haven't paid their assessments means that maybe they're having trouble paying just their assessments. So if we're adding $400 onto their account versus $190, that makes it even harder. So it's really in everyone's benefit to be as efficient as possible, and that's why we use Barcelo and Associates to do it in bulk. Some management companies prefer to not do the liens. In the old days, management company used to be able to sign them. The law was clarified several years ago that says liens cannot be filed by anyone but an attorney. So some management companies, a large number of them, said, okay, we don't have to do them anymore. We'll just send them to the association's attorney. We took the other approach that I just described. One of the main reasons we wanted to keep the liens in-house is it gives us two more opportunities to solve the problem and work with that homeowner before it goes to the attorney and the prices really go up on the chargebacks. The two steps are, we tell them we're going to file the lien, we file the lien, we show them the lien. And so those are two great opportunities for us to be able to work things out without involving the attorney, and we keep everyone's costs down. The one really quick thing I do want to point out, that we file a notice of lien. We're not filing a lien. What does that mean? Well, the CC&Rs, your governing documents, already say in it Every single property in this community has a continuing lien on their property that's there at all times. So a lien is simply a right that is placed upon a property. And so that is already there. It was there before you bought your home. And so all we're doing is we're filing a document that says it's a notice that that lien exists. We file a document that says, hey, this property has a continuing lien on it by virtue of the governing documents. And by the way, right now, they haven't paid their assessments. So the lien is already there. We're putting this notice out there so the whole world can see that monies are owed. That step, by putting it in the public records, is what triggers all the credit reporting bureaus to pick this up, and that's how it shows up on their credit reports, by filing it in the public records. Now maybe when we sent the owner a copy of that stamped official document, we actually send them the original. I mean, it's got the blue ink on there or whatever color it is. This is obviously the original signed by the attorney. We want them to see this is real. We send them the original. We, of course, keep electronic copies of everything. We send them the original, and maybe they say, oh, I think we'll pay. At that point, we need to do a release of lien. We do the releases of liens once a month, around the third week of the month. Any releases that are needed in any of our communities, we do them all at one time. Again, we do them in bulk. It keeps costs down for everybody. The attorney prepares or uses the electronic data to print, sign, notarize, file electronically the releases. Now, if a closing is about to occur on a property, a title company will say, hey, we're not going to close, that lien's still outstanding. Then we work with them. We'll either send them a letter that many will accept that says, we will release this lien on March 23rd. In other words, give them an assurance of a intent to release lien. Some will accept that. Others say, nope, we want that lien in our hands, we'll file it. In that case, we work with Barcelo and Associates. They do a quick release, either file it electronically immediately if there's time, or have it delivered to the title company, who then feels comfortable, I've got it in my hands, we'll go ahead and file it. So we work with title companies however necessary so that we are helping them take care of a closing. If the owner still hadn't paid and they want that release, we are comfortable giving that release to the title company to file, and in trust, taking that release from us in trust that they will then send us the full amount that is owed. And that's a fiduciary duty of a title company, so we're always comfortable if we're handing it to a title company, they will hand back a check for payment in full. And it must be payment in full. One of the things we state on the lien is listed right there on the slide. It says that affiant, us, we give notice of the claim on this property, which claim shall continue to accrue in accordance with the declaration. What that is saying is, we've got a lien. If next year's assessment pops up on here and you haven't paid off what we filed it for originally, the dollar amount we filed it for, we're not going to release it until the full amount, everything that's accrued since we filed it, all of that is paid. So truly, the assessment must be paid in full, the whole balance on the account, before we're going to release a lien. Well, if the lien didn't work, then we're not filing the release. It's time to now make a recommendation to the board of directors to go to the attorney. We do that on our collections update report. It's a cool report that's printed in declining balance order. So you have the people who owe the most at the top, who owe the least at the bottom, And there's a graphical section in there where it shows the progression from lien being filed at the attorney, lawsuit being filed, judgment. It has if they're on a payment plan or in bankruptcy. And so you can see if we, the management company and the association, are handling collections consistently, just graphically by looking at it. But on that report is where we will mark, for example, the column D, which is attorney demand letter column. We'll typically mark that with a black mark or a red mark, and that's telling you we are recommending to you, the board of directors, that this particular account, we want to take this step, turn it over to the attorney. And so what you'll normally see is a whole group of them all together who have similar balances that all have the same mark. If someone is on a payment plan, so there's an X in the payment plan column, you won't see a black mark in the recommendation column. So that's the way we do our recommendations on sending accounts to the attorney. So if the board approves it, we then verify ownership through the public records. We compile a file that we put together for the attorney that has account history, has the verification of ownership, and has any what we call collection comments. So it'll have every phone call from the owner, any return mail, anything that happened. If they're on a payment plan, that we sent them a reminder letter that it was voided. All that is in words that's attached to the file we prepare for the attorney. At that point, we do put a fee on the account for turning this over to the attorney. We send it over to the attorney and they send out a demand letter. At that point, the manager becomes a liaison with the attorney, working with the attorney to try to get resolution. Internally, once we turn things over to the attorney, it's important that we don't interfere in the collections process from the standpoint of allowing the homeowner to get around the attorney and say, oh yeah, I got a demand letter, but let's make a deal on the side. And so once something goes to the attorney, we do a lot of flagging internally, automatically in our system, that makes sure that we don't speak to someone about their account if they're at the attorney. So you can see at the bottom there, it's just a little screen print that shows that all of the screens having to do with this account, once it's at the attorney, it has in red print, AR at the attorney, accounts receivable at the attorney. That tells everyone in our company when they call in or if they send a letter if they call in to let them know very politely and professionally that here is the attorney you must speak to, here's their phone number, please call them, we can't talk to you about the account. That shows up on all the screens, so our staff members, no matter who answers the phone, they will know that this account is with the attorney. We can also flag those accounts at the lockbox. We can either tell Mutual of Omaha Bank if a payment comes in, we have two options. We can tell them to reject the payment, put in that little exception thing that I talked about earlier, show it to us the next day, then we'll give the bank instructions. Mail us the check, deposit the check, whatever our instructions are. Or we can tell the bank, if we get money from someone at the attorney, we're going to take it. Money in hand is great. In which case, our software tells us the next day, hey, you got a check from John Doe who was at the attorney, you got a check for $100, let the attorney know. So we have those two options as to how we handle payments that come in. Statements. When we're sending out statements, we must send a statement, for example, in November to tell them about next year's assessments. Those statements have in bold print the statement, the words that you see up there. This account has been turned over to an attorney for collections, and this statement may not include all legal fees. Please contact attorney name at phone number for payoff information. So even when we're required to communicate with that owner about their account, we put this big disclaimer on there telling them to call the attorney. So it's at the attorney, and the owner still hasn't communicated, paid, or gotten on a payment plan. It's at this point that we need to recommend to the board that a lawsuit be filed. There may have been several demand letters. We may have asked the attorney to send the first one and then maybe a harsher one. But we come to the board. On that same collections update report, we would mark column E. Column E is the column that is indicating lawsuit. So if we've marked that column, we come to the board meeting and say on line number 17, we're recommending that a lawsuit be filed. The attorney will then make a decision. You can file a lawsuit in multiple courts in Texas. You can file in a district court. You can file in a JP court. You can also file in a family court, surprisingly. I want to talk about what those are, but first I'd like to answer a question. So, what sort of question do we have?
Ralph, we have a question this evening from Donna Witt out at Flying L. She wants to know, how does the collection process differ when the person who owes past due assessments passes away?
Oh, great and difficult question. Just to recap that, to make sure everyone got it, there are certain things which make collection more difficult, and I'll actually be talking about a few of them in a moment. But one is, let's say you have one person on the deed. We've been using John Doe, so John Doe is the only one on the deed. There's not John and Jane Doe, it's just John Doe. And John Doe passes away. When someone passes away, you certainly can't serve them. You probably know where they're at, but you have to serve a live person, and so that would not work. And so there's nothing you can do until the property goes through probate. When it goes through probate, the title of that property then goes to someone else, to a friend, a spouse, a child, whoever it might be. And once that occurs, we would then contact that particular new owner of the property, provide the information. It's not a typical conveyance like if a property is sold through a title company. And so anything that's on the account doesn't disappear when the person passes away. It would continue on to the person who gets the property. Probate doesn't always happen as we would want it to. And so that's actually a more complicated topic about what we would do if it doesn't go through probate. In other words, the title doesn't pass to someone else. So I'm going to not get into that direction, but come back for advanced topic for board members, and we can get into how you deal with some of those really tricky situations. Thank you, Donna. Appreciate it. Okay, so let me get back to the way you can file. As I mentioned, you can file in any court. These sort of collection lawsuits are almost always filed in district court, state district court. And the reasons for that are because of what I'm going to say about JP court. JP court has some definite advantages. It's cheap. The cost of filing in JP court is typically under $100. The cost of filing in a district court is going to be a couple $100. And that doesn't even take into account the actual preparation of the lawsuit petition and things like that. That's just the filing fees. Although an association can represent themselves, in other words, a board member could be the one who prosecutes the case in district court, you really, really need an attorney. In JP court, you really should have an attorney, but a JP would allow a board member, for example, to be the one who testifies and brings the case on behalf of an association. And it's quicker. The backlog in JP courts are generally relatively short. In district courts, generally relatively long. So why not use JP courts always? Because of this. A JP cannot order a foreclosure. Simple as that. They can award a monetary judgment, but not the right to foreclose. And foreclosure is one of those things that we never want to do, but it is a very big incentive for someone to take care of the problem. So if we get a judgment in JP court, they can just say, hey, try to collect it. We don't have the hammer. And if you get a judgment in JP court, you can't say, well, that didn't work, so let me sue him again in district court so I can get my foreclosure order. No. There's a Latin term, res judicata. You have your choice of remedies. You have chosen to go the JP court route. You can't then say, I want to go the other way. Once you make that decision, that is your decision. Now, if the next year's assessment becomes overdue, you could then file on that. The last item is that if anyone in a JP court ruling doesn't like the result, they can appeal from JP court, just like you can appeal from any place. The interesting thing about if you appeal from a JP court, if you appeal that judgment, it goes to district court and you have a brand new trial and process in district court. So the bottom line is district court is where these lawsuits are taken care of. It's really a fascinating part of the advanced topics seminar when we go through an anatomy of a lawsuit and all the twists and turns that can go there. So if you've ever watched Law and Order, you have enough information so that you would enjoy that part of advanced topics for board members. Let's move on to what happens. We now have gotten a judgment, and we're going to assume this judgment occurred in district court, so we have the foreclosure option available. What happens is, today a judge rules, either in court and bangs down the gavel, or the judge signs off on a judgment. In advanced topics, we'll talk about why sometimes you go to court and stand in front of a judge and other times you don't have to. But the day that judge signs the judgment, it's not a final judgment until 30 days later. So you have to wait 30 days till after they sign their judgment to do anything. In advanced topics, we'll talk about why that 30 days is there and what can happen in that 30-day period. Once it is final, in other words, 30 days after the judge has signed it, then what normally happens, let me say what normally doesn't happen. What normally doesn't happen is the homeowner doesn't normally come in and hand you a check for the full amount of the judgment, unfortunately. So after 30 days, the attorney will send out a post-judgment demand letter. It's another demand letter that says, hey, look, here's the judgment signed by the judge right here. And we would suggest you pay, because if you don't, these are the things we're going to do. And that's where the attorney talks about potential foreclosure and things of that sort. One of the things we always want to do if the owner has not paid, communicated, got on a payment plan, or reached some sort of a settlement, is we'll want to file what's called an abstract of judgment. Think of an abstract of judgment as something similar to a lien. It's a notice. It's a notice that goes in the public records, filed in Bexar County, Harris County, Brazoria County, or wherever the property is, that says, hey public, look, a judge signed off that this person owes this money. And so An abstract of judgment is simply a notice to the public. It's a one-page document, a notice to the public that says there is a judgment on this person and related to this property. The cool thing about abstract of judgments is you can file them anywhere you want. You can file them in another state if you want. I am not sure if you can file them in another country. That's an advanced topics for board members. But you can file them in another state. Why would you want to file them in one of these in Colorado? Why would you want to file it in Galveston County? Well, you might want to file it in Galveston County if they've got a condo down there, if they have a business down there, if they do anything where it might be picked up and give them incentive to pay. In Colorado, they got a timeshare out there. I have a second home out there. A abstract of judgment puts a significant cloud on title, and you want to get it close to where they live, operate, work. So that's a nice thing about an abstract of judgment. Put it out there, it will provide incentive for them to pay. So we've gone through this whole process, and we haven't talked too much about the post-judgment remedies, which is another whole set of really interesting things. But let's look at the collection resolution experience. What we have here is what we've just talked about. All of the steps through a lawsuit, and then the bottom part of what you see up there is information about the post-judgment remedies. And we put percentages beside each of them. One of the ones that may surprise you because it's so low is how many people actually pay by the due date. These are numbers with C.I.A. services over lots of years, lots of communities, and these are approximate numbers for maybe the typical community. And only just under 80% of owners pay by that January 1st due date in an annual assessment. A bunch are paying in January, but by the January 1st due date, about 78%. That sounds kind of low, doesn't it? You might say 78%, that's terrible. That 78% ends up being a very high collection rate, but let's go through them. After the past due statement, we're up to close to 90%. After the certified letters, we're up to about 93%. If we then file a lien and send out that lien, we're up to 96%. If an attorney demand letter is sent out, then it gets up to 98%. Lawsuits, if that's filed before we even go to court, we'd be at 99%. The number that actually go to a judgment is minuscule. It really is. And then if we actually get a judgment, to have to, and the owner not coming up with a payment at that time is extremely rare. So going into lots of post-judgment activity is rare. Foreclosures, extremely rare. It's something you hear about all the time, but HOA foreclosures where you have a management company following a really good communications and collection procedure like this are extremely rare. I don't really know how many that have occurred with C.I.A. services over the 33 years we've been around, but it's a really small number. There may be, one a year where we actually foreclose on a home out of the, 50, 60,000 homes that we have in the 170 communities. It's very, very rare. And then if you foreclose and the homeowner still hasn't paid and you have to evict them, I think I'm only aware of 2 in the life of C.I.A. services where that's actually occurred. There may be 3, there may be 4, but it's tiny over that period of time. It's very, very rare. So that's the collections experience. It's interesting to look at that. And even though you may be low on January 1st, by the time we go through the process, before we get to the attorney, you're in the upper 90s, which is what's important. Let's now talk about the things that can stop the process. Well, certainly someone making a payment will stop the process, but what else will put things on hold? The most important thing are payment plans. We have always offered payment plans to our communities, and in fact in 2011, the state legislature said that's the right thing to do. It always was. But the state legislature said, effective January 1st, 2012, all associations must adopt a payment plan policy and offer payment plans to their owners. Now, all of our associations have these payment plans, so you could just go to our website and look at your payment plan policy. And if you're not one of our clients, go to our website and look at any of our clients to see what a payment plan policy should look like. So once an owner becomes delinquent under these policies and under state law, an association must offer that owner a payment plan. The policy itself puts the parameters on the payment plan, and state law adds parameters to the payment plan. And one of the parameters that state law has is that if an owner has defaulted on a payment plan within the last 2 years, you don't need to offer them a payment plan again. That's what the law says. That's what your policies will say. The reality is, if someone comes to the association, to the management company and says, I know I defaulted last year, I want to make payments, I want to try to make this right, I'm in better financial shape now, we're always going to want to accept a payment plan. It has to be a reasonable payment plan, and those are some of the terms that are listed in your policy. So the law originally indicated that you could accept that an owner could request a payment plan up to 18 months. So if they owed $180, literally they could say, I will pay you $10 a month. That's not necessarily reasonable. So in our payment plan policies that you'll read, there's guidelines as to how much you owe and what a reasonable length should be. So if you only owe the current year's assessment, and interest maybe, then it says a reasonable number of months is 3 months. If you owe a little bit more, 6 months. If you owe more than that, 12 or 18 months. The payment plans, since every board has adopted a payment plan policy, we, the management company, don't come to the board and say, will you accept this payment plan? Because if it's in compliance with the payment plan, it's, they want a 5-month payment plan because they owe 2 years worth of assessments, we automatically will approve anything that's in compliance with the plan. We send them a written letter saying you're now on this payment plan, here's your monthly payment, here's your down payment. We even tell them that over the life of this payment plan, if you make your payment plan, your payments on time, you will pay this much in interest. So we give them all that information. It's really helpful for them to have some structure to help them through this. We're always suggesting that the owner set up their payment plans through our website. And if they do that, they can set it up for automatic payments. If they have 3 payments they're going to make of $200, they can schedule those to just draft it right out of their bank account on the 25th day of the month or whatever they specify. And so we like them to do that. Not everyone does that, but it's an option that they have. Now, sometimes people promise to make their payments and they don't. Many people who are on payment plans are having financial struggles, so things come up, other priorities come up, and they don't make their payments on time or the right amount. And so Analyzing payment plans is not straightforward. You can't say they were supposed to pay $233.18. If you don't see that payment, you get upset and send them a reminder letter or something. We use what we refer to as fuzzy logic. Fuzzy logic is simply this. We are able to, through our analysis program, we're able to determine if they have generally lived up to the payment plan. We allow for variations in timing. It was supposed to be on the 25th. Was it by the end of the month? They should have made 2 payments by now. They missed last month, but they made a double payment this month. Did they make approximately the amount of payment they were required to? So we look at it that way. If someone is not living up to the spirit and close to what they had promised to do, we send them a reminder letter. We ask them to make up any past payments and come current. If the next time we run the analysis, and we run it at the beginning of every month, the next time we run the analysis, if they still haven't come current, then they get a letter that next time that voids out their payment plan. Tells them it's voided, we're going to continue the collections process where we left off. And as I mentioned earlier, we keep track of if someone successfully completed a payment plan or if they voided a payment plan, so we know if they avoided one in the past when they come to us the next time. The law does allow us to not give them a payment plan the next time. Now, with all that said, now I want to talk about our multi-payment option. One of the things we do at C.I.A. Services is when we send out the annual assessments, and again, we'll stay on an annual assessment scenario here. One of the things that people often complain about is that, gee, you're sending me this statement for the full amount that's due on January 1st, and it's Christmas time, and I've just paid all my Christmas bills. It's a tough time of the year. Most associations don't have flexibility on that because that's when it is defined in the CC&Rs. And so one thing we try to help people with is what we refer to as our multi-payment option. So just as an easy example, let's say an association has a $600 assessment. So we'll send the statements out in plenty of time, in October and November, and we'll send them a coupon for $600 due January 1st. That's the normal thing that's in the deed restrictions. That's what's required by the deed restrictions. But we'll also send them a sheet of paper that has maybe three other coupons, each for $200. And the first one may have the coupon says pay $200 by November 15th, $200 by December 15th, $200 by January 15th. So they have paid the full amount prior to the January 31st overdue date. They've been able to break it up into 3 payments. They don't have to fill out any paperwork, sign any payment plan agreement. It's just an automatic multi-payment option that they can take advantage of. Now, it's really interesting. We've been doing this for so many years, and it's interesting to see the trends on use of our multi-payment option. Across all of our communities, about 25% of our owners take advantage of that. And it's not the same people every year. Sometimes someone will pay in full. When you look at their history, the next year they're paying it in 3 payments. Next year they're paying in full. But the important point is, it's an easy option for someone to take advantage of, and it's available to 100% of the owners 100% of the time. So they can do it or not, their choice, easy, 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 without any paperwork. Now, your payment plan policy and the state laws do not limit or define whether or not you can withhold privileges or rights from owners. let me indicate what we do unless a board has directed us otherwise. If an owner is on an active payment plan, we will allow them to get pool tags, use facilities, and any of those things. But a board may choose to say, nope, until you're paid in full, you can't get your pool tags. That's a board decision. But our normal default is, if you're on a payment plan, we appreciate you being on a payment plan, and you're going to be able to get your documents, your pool tags, let's say. Very specifically, though, starting in 2012, the law says you may not withhold someone's right to vote for any reason. So payment plan, no payment plan, you can't withhold a right to vote. The next thing that will stop collections in its tracks is a bankruptcy. And there's so much we can talk about on bankruptcies, and we do talk about it in advanced topics for board members. But basically, there are three types of bankruptcies. There's a Chapter 7, there's Chapter 11, and there's Chapter 13. 7 and 13 are the two that apply to homeowners associations. There's a whole cast of characters that are out there. There's the debtor, the owner who owes the money. You have the creditors, everyone he owes money to. You have the debtor's attorney, that's the one who prepares a bankruptcy petition, submits it to the federal bankruptcy court. You have a bankruptcy trustee. Once it's accepted by the court, the trustee is the one who makes sure that that owner is living up to the obligations of the bankruptcy, the payments, and distributing those payments to the creditors. And then you have the judge who ultimately makes all the decisions. If someone files for bankruptcy, then all creditors, including the homeowners association, must file what's called a proof of claim. The debtor has said, oh, I owe $500 to my homeowners association, but that may not be accurate. That's why a creditor must file a document with the court affirming that a certain amount is due and giving them the breakdown. Once the bankruptcy is affirmed and approved by the judge, in a Chapter 13, for example, a Chapter 13 is essentially a payment plan. And so the court will accept whatever payments from the creditor, from the debtor, that will then be distributed to us and everyone else. And so we don't get to say, we only want payments for 6 months and we want to be paid in full. The court determines what payments we will receive. While things are on, while that owner is in bankruptcy, everything is basically on hold. On this slide, we do talk about the different types of creditors. An association is a secured creditor. Priority creditor is essentially the bankruptcy trustee, gets the first payments that come in. Secured creditors are anyone who has a lien right or a judgment right. We have a lien right, a mortgage company would have a lien right. And then there are unsecured creditors, which are everyone else. And in many cases, the unsecured creditors, especially in a Chapter 7, do not get anything from the debtor regarding what was placed in the bankruptcy. Now, just want to touch on a couple other things about when someone is in bankruptcy. The trustee does monitor whether or not the debtor is making payments, but typically they're not going to really do a whole lot until someone complains, until a creditor says, hey, bankruptcy trustee, we haven't been getting our payments. A loan on a car, for example, they may go back to the trustee and say, we haven't been getting our payments. Please allow us to take back that truck, that collateral. And so you can go ahead and ask for relief from the bankruptcy court. But that's unusual, and in an association, almost never will go through the expense of going back to the trustee. However, once someone is in bankruptcy, an association absolutely may not proceed with delinquent collections, period. The trustee will not be very receptive to us violating that stay. And we may not, absolutely may not withhold any rights. We'll get into a lot of additional detail later. But I've got a question right now, and then Kim is also going to turn on her other mic so that I can hear her. So what questions do we have, Kim?
Ralph, this evening we have a question from Donna Witt, and she'd like to know, how does an HOA board know when an owner has filed bankruptcy?
Oh, good question. How would an HOA know if someone has filed for bankruptcy? Well, there's a couple ways. First of all, the creditor almost always is going to be naming the association. If they owe you money, they're going to name the association on their bankruptcy petition, because that allows the court to contact you, the association, and say, stop, don't harass this debtor. They are under the protection of the federal bankruptcy court. So almost always the debtor will tell the court will then contact you and let you know, back off. Sometimes that doesn't happen, but it would be unusual that the debtor wouldn't name everyone they owe money to. If you're going down this road and you do send something to them, the debtor would then generally complain to their bankruptcy attorney, who would then threaten the association. If you contact our attorney again, they're under federal bankruptcy protection, you're going to be in big trouble. So if you end up sending something, generally the bankruptcy attorney will let you know. And then finally, if you send something, send it over to the attorney. Your attorney is always going to do a bankruptcy search. It's a very simple thing for someone to do to determine if someone has filed for bankruptcy. So good question. Let me go ahead and get off bankruptcy, and we're going to finish the topic of collections and then go into financial reports. Keeping track of owners is extremely important. If for no other reason, you can't collect from someone who you don't send a statement to. And so we have a number of ways that we are constantly keeping track of ownership. One is when someone normally buys or sells a property and goes through a title company, we're going to be getting the information from the title company. We'll know that the property has changed hands. We also at C.I.A. Services subscribe to something called foreclosure listing services in the various counties where we operate. And on those services, we get information about properties that sold at a foreclosure sale. If we see any of our properties on there, then we can do the research needed to find out who the new owner is. All of the mail that we send out, there's a little statement on the envelope that says return service requested. What that does is we end up paying a little extra for it, the association does. What happens is if someone has moved and there's a forwarding order on file, and that forwarding order would be out there for a year, then this happens. One, that piece of mail does get forwarded to the owner. And secondly, the post office sends us back a picture of that envelope that shows the new address. And when that comes back, we pay the post office, I'm not sure exactly what it is. I think it's probably in the range of about 50 cents for that information that came back. So that's really valuable for us to be able to track someone who's moving around. Whenever we get any return mail, mail that's undeliverable, not the kind where we know where they've moved to, but undeliverable. That goes ahead and triggers research that we do internally, everything from appraisal district records to public records. Sometimes we send a help letter to, if it's a rented property, we'll send something to the tenant saying, help, who do you pay your lease to? We may have email addresses or phone numbers for that owner that they still have that we could contact them. If there's realtor signs, maybe board members might have input. And ultimately, we've even resorted to, for an association, to hire a private investigator to try to find the person. But the key is, you need to know who the owners are and how to get a hold of them for good collections. Bounce checks, nothing too interesting here, but if a check is returned as unpaid, we will send the owner a letter by certified mail that has some really harsh language in there relating to the laws for return checks in the state of Texas, but it's pretty harsh. A fee goes on their account, and generally the person makes good on the check. If they don't, it's still on their account, and it's something we don't typically pursue beyond the normal collections process. One of the things we can do, we've done it a few times over the years, but it's not done often, is when someone bounces a check, that's a misdemeanor, that's a problem. And if it's large enough, I don't know what level of misdemeanor it is, but it's a misdemeanor, which means the county attorney can follow up on that. And a constable or a sheriff can go to their door to try to collect. They can issue a warrant for their arrest and all sorts of nasty stuff. We typically don't go that direction, but it's possible. Last thing I want to just briefly touch on in this segment is credit bureaus. We do not report things to credit bureaus. It used to be in the old days you could fill out forms, you could mail it into the three main credit bureaus, and they would put it on file that a person owes money. There's no reason to do that because the credit bureaus check the public records. That's why we do liens. That's why we do releases. That's why we do abstracts of judgments. That's why we do releases of judgments. All because of that. In our certified letter that we send out, we specifically tell them that when we file this lien, it will be reported or will be picked up by the credit bureaus and it'll impact your score. So we don't go to credit bureaus. So I think we have another question, Kim.
Yes, Ralph, we have a question coming from Jimmy Burley. He would like to know, how does the association document new home building and sales or ownership in the subdivisions, documenting new homes and owners?
Another great question. Jimmy's from Country Colony. Country Colony was one of our very first communities back in the 1980s when we started managing Country Colony. So great, nice community. I've gone to many parties on their vacant lot areas. So the question was, how does the community track either home sales or new home construction? Lots of variations of that. One of the things that we do in our software is we're tracking, of course, ownership changes. Anytime a property changes hands, we certainly know about it. And if a community, for example, has a welcome committee or other groups that like to visit with new owners, we can generate a new owner list on a monthly basis, quarterly basis, whatever period of time. And so we have that information. In some of our communities, they like us to put the new owner list in their board packages. And for the larger communities where you may have 2 or 3 or 5 or 10 sales per month, that works out great. If you're a small community with only 5 sales per year, a monthly report doesn't work too well. So that's how we go ahead and do that. And I hope that answers the question. Let's go ahead and move on. In our last 20 minutes, we're going to talk about accounting reports. Let me start by talking about the various accounting methods. There's two main accounting methods that are accepted by American Institute of Certified Public Accountants, AICPA. One is the cash basis. Cash basis is simply described like this. You account for your cash revenue when it comes in. So just like in your checkbook, when you get your check from your employer, you write it in your checkbook on the date that it goes into your bank. And expenses are accounted for when you actually spend the money. So when you charge something on your personal account, when you write a check. So it's a cash basis. It's relatively simple. The preferred method of CPAs and the method that is used on all audits, all financial statements for publicly traded companies, and all of those things is an accrual basis. Accrual basis is a little more complicated because it works this way. The date of a transaction is when the revenue is due. Not when you actually get the money, but when it's due. I'll give you an example in a second. And expenditures, your expenses, are logged as of the date that you committed to that expenditure. Not when you actually paid for it, but when you committed. So from an association standpoint, if you have annual assessments with a January 1st due date, on January 1st, your financial statements would show $100,000 of income on January 1st. That was the due date. That's how much you billed out to everyone. So your income statement would show $100,000 on January 1st. It would show zero the rest of the year. And for an expense, if you agree to resurface the pool and issue the work order today, it shows up on your books on March 23rd for $25,000. Even though you may not do it till next month, or you might write a check for half today and half for next month. It would all show up today. So that's the accrual basis. And there's a real good reason that accrual basis works for comparing publicly traded companies or for comparing year to year in your own association when you have a CPA audit. But we don't use either of those methods. We use one that makes much more sense for a community association and the way associations operate. And we refer to as a modified cash basis. If we're talking to a CPA, sometimes we'll call it a modified accrual basis because that'll make them smile. But it's the same thing. Essentially what we're doing is, for most of the things we're doing, we're operating on a cash basis. So when a homeowner makes a payment on March 23rd, it'll show up in March. When we write a check for the grounds maintenance contract and we write it today, it shows up on March on the financial statement. So far it sounds exactly like the cash basis. The difference is how we handle end of year and beginning of year transactions. What we want to do is we want to align your financial statements with your budget. So if you budgeted for 12 months worth of streetlight payments, we want your financials for 2016 to show 12 months worth of streetlight payments. Even though you're having it drafted and the December streetlight payment comes out of your bank account on January 5th. So what we do is at the end of the year, we accrue expenses. In other words, something that we know, we're going to get that attorney bill for December expenses. We're going to pay it in January. We're going to book it into 2016. That's called accruing expenses. We put those expenses into an accounts payable category And then when we actually write the check, it comes out of that category. And then we also defer revenues. So we accrue expenses, we defer revenues. What does that mean? Well, remember, we sent out our statements in October, November, December, and 88% of the people paid by December 31st for next year's assessments. So all that money that came in advance, we didn't want to show it as December 2016 revenues. Those were their 2017 assessments. So we defer those revenues and show them on the January books instead of the December, November books. So that's the difference between cash and accrual and our modified cash that aligns everything with your budgets. So now let's talk about the financial reports. And I'm going to briefly go over the highlights of these so we'll have time to trace transactions. And up here we have, you have your income statement and variance reports. Those are the reports which show transactional activity. How much occurred in a particular month. We then have a balance sheet. A balance sheet is a snapshot in time. It says how much do we have, for example, in the checking account as of February 28th. We then move on to our collection summaries, trial balance, or some people refer to it as a general ledger activity report, and then our collection updates. So let's go ahead and look at the income statement. Lots of information up here, but you've all seen this. But the key on our income statements is that we have our revenues up at the top, expenses in the bottom portion, and then our net income. Across the top, we show the last 3 months. Doing it that way, you're able to look for trends. We have the year-to-date total, the annual budget, and then the percent of budget. So you can tell, for example, if you're right in the middle of the year, you're looking at the first 6 months, and you have something like a streetlight bill, well, after 6 months, you'd expect to be somewhere around 50% in the column on the right. So it's a really nice report that is grouped in a way that will provide you a few months worth of historical information, plus what happened in the current month. In the upper left-hand corner, you can see that it says, in this case, March financials in the word preliminary. Preliminary, that's something that some folks don't really know what that means. It's real simple. Preliminary simply means it hasn't gone through our financial close process. So we can run a preliminary report for March on March 31st, on April 1st. It may be missing bank interest, which is typically the only thing that it's missing. And it hasn't gone through a final review by the financial manager who actually presses the button that says close the month. On the balance sheet includes the last 3 months. A balance sheet is called a balance sheet because it has a top half and a bottom half which must equal each other. So all assets on the top half must equal liabilities and equity, which is on the bottom half. So it's got a lot of good information on this. People are most interested in the upper right-hand corner. How much cash do we have? We as community managers often try to get you to concentrate on the lower right-hand corner, which is where all of our equity and our fund balances are, which we'll talk about in a moment. We have our collection summary. Great little report that shows the assessments that had been billed out for a number of years. And over on the right-hand side, it shows the percent that's been collected. In the middle, it has the amount that is still outstanding, and then the right-hand side, percent collected. So you can see where we are for some of the old assessments, where we are for the current year assessments. Another nice thing is the column that says the amount invoiced. That kind of gives you an indication of what the assessment rates have been over time. So you can see in this particular example, way back in 2004, the total amount billed out was $40,000. Then it increased all the way up to somewhere in the range of $56,000. You'll notice that in 2015, it actually went down. This was an association who was trying to build up their reserves. They did. They actually reduced their assessment in 15, and I think it may have dropped in 16 and possibly 17. So they were taking advantage of the super budget, know where they were, and were able to reduce assessments. That's unusual, but they were able to do it. On the next page here, next slide, this is our trial balance report. There's a reason it's called that. Some people call this general ledger activity because that's exactly what it shows. So in the upper portion of this screen, we have, for example, the activity, the things that have occurred in the checking account. The starting balance in the checking account is shown right there. You can see that we had a lockbox deposit, which was a debit. We'll talk about debits and credits just in a moment. And then, so debit in the case of a bank account is a good thing. It's money going into the account. Whereas a credit in a bank account is money coming out. So you'll see that we wrote 3 checks there. And then we also had a bounce check. And you'll see that at the end of that period, there was about $27,000. So this right here is a really nice report when you're trying to figure out, you're looking at the income statement and trying to figure out, okay, so what did we pay for in general maintenance? Well, you can turn back to the trial balance and you'll see all the details, whatever happened that particular month. All right, let's now talk about the topic of fund accounting. And fund accounting is something that you see when you look at our super budget. There are 4 funds that you might see on a balance sheet. There's something called an operating fund, a replacement fund, a capital fund, maybe, and a special purpose, any of a variety of special purpose funds. And those are simply places where we accumulate money. Many people refer to these as reserve funds. They're absolutely reserve funds, where we put money aside for a specific purpose. So for example, the replacement fund, we put money aside such that when it's time to resurface the pool, do something with our monument, replace a tennis court surface, all of those things we put money aside. When it's time to do the project, we go ahead and take it out of those funds that were reserved or set aside for that purpose. Capital fund is if we wanted to create something new, put in a new playground that we don't have. So not all communities have capital funds. Special purpose fund, when you come to the super budgeting seminar, you'll hear all about what those might be. So in fund accounting, you see contributions into those, in other words, money we're setting aside for future use, at the bottom of your income statement. And there's a little excerpt from an income statement here showing that in this case, this community is making contributions each month into their replacement fund and contributions into a capital fund. And by the end of the year, this particular community would have put $27,000 into their replacement fund and $350,000 into their capital fund. There's clearly a story behind that we'll have for another time. So we accumulate those funds until we need them. And you see the accumulation over on the balance sheet. And so if you look at the sample that's right there, you see in this particular community, they have currently a replacement fund value of $124,000. They use something called a discretionary fund, which is one of the special purpose funds that you can have, with $17,000 and an operating fund balance of $65,000. One nice thing about the way we handle this reporting is we have what the orange arrows are pointing to, which are the current year expenditures. So these are the projects for this year. So you can see this particular community has spent $27,000 on replacement and refurbishing projects and $12,000 in discretionary projects. So that's how funds work in the interplay between your income statement and your balance sheet. Now I want to just trace a couple things real quick through the trial balance report. So in this particular case, we're showing that a payment was made for about $4,000 to a vendor by check number 759 to Certified Landscaping. And you see it's coming out of the checking account. It's a credit to the checking account. And you can see then it's a debit to the expense account. So $4,000 of that was for the grounds maintenance contract, and then $41 was for a forced maintenance. Debits and credits always must total to the same number. And so that's how you could track. You see that we wrote a check for someone. Further on down on the trial balance, you can see exactly what it was for, if it was for multiple things. Now, we wrote that check in November, so it's actually going to show up on your income statement. You will see circled under grounds maintenance contract, there's that $4,000 that you just looked at in the trial balance. There's the $41 that you just looked at on the trial balance. But it also shows up on your balance sheet because that bank balance has now been reduced by $4,000. Why aren't you seeing $4,000? Well, because this is a balance sheet. It's showing you the accumulation of all the transactions for the month, which may have included some deposits, some checks, some bounce checks, and all sorts of things. So there is an impact on the balance sheet of both deposits and both debits and credits, deposits and expenditures. This goes into a little bit more. I'll let you go ahead and study this one later, but this shows you everything that happens with a deposit. Money goes into the bank. We reduce the amount of money owed to the association since it's been paid, and we show it as a revenue. So it shows you a little bit about a deposit. I want to just briefly talk about about CPA audits and then get on to our last topic. So CPA audits. There's something called a compilation you can ask for a auditor to do. You can ask them for a review or an audit. A compilation is you simply give them your numbers and say, make it look pretty, put it in the right format. They do no examination of it. So compilation is not something an association would ever want. A review, you give them your information and they do almost no checking. They make it put into the right generally accepted accounting principles format. But again, it's not what an association would want. You'd want a real audit. And on an audit, what the CPA does, they examine contracts, they examine minutes, they examine, of course, your financial reports. They look at a representative sampling of all your checks in the backup, your deposits. So they're looking at everything, trying to verify that everything appears to be proper. And very importantly, they will then go to outside parties. They're not just going to depend on what you've given them, but they will go to your bank and say, bank, will you please verify what the balances are for this association? So they get third-party verification of what information you gave them. They will then go ahead and put all that information into an accrual format, issue a report, and that report hopefully will have what we refer to as a clean opinion. A clean opinion basically says that the information that we're presenting here fairly represents the financial condition of the association. That's a clean opinion. C.I.A. Services is very proud in 33 years of audits by hundreds of times, thousands, certainly over 1,000 times. We have never had anything but a clean opinion on our book, so good job, C.I.A. Services. Let me get into the last section here. Just have a few minutes left, and for anyone who wants to hang around a few minutes later for questions, we'll certainly do it. I want to go over the C.I.A. Services Expense Recovery Program because it's a really nice thing that we offer our clients. And the way it works is it allows associations to recover some of the administrative costs that are associated with delinquent collections with deed restriction enforcement. Every time we need to send an extra statement to someone, you, the association, you're paying that postage, you're paying the copies, you're paying a portion of our time. And so this program allows associations to recover the cost. These fees that go onto accounts are split because it takes more of our time, and we don't want that to be in our base management fee that every owner has to pay. We want the people who are causing the extra work to do it, so we get some part of that fee. And the association gets part of that fee because you've paid for the postage, you've paid for filing fees, and all of those sort of things. And we've set the split such that the association's costs are fully covered at every step. The next page shows what our program is. The total fee is what gets billed back to the owner's account at that step in the process. The manager portion is what we get paid. The association is what the association retains. To explain that better, though, here's what happens. If we put a $40 late fee on someone's account, it's invoiced to the account. That's all that happens. It's on their account. Red Dog, once that owner pays, and I'll introduce you to Red Dog in just a moment, once that owner pays, Red Dog automatically does the distribution of that late fee. It puts $20 of that late fee into that general ledger account 6115, which is office expenses recovered. That's what the first orange arrow is pointing to. And it goes ahead and puts the other $20 into accounts payable for C.I.A. services. That's what the bottom arrow is pointing to. So if you go ahead and look at the note there for that particular financial statement, it's showing that in that month we collected 4 $40 late fees. So $160 came in, $80 is shown retained for the association, and $80 would then be paid to C.I.A. services the next month. I've got another question, but I do want to put the slide on Red Dog. So for those of you who don't know what Red Dog is our management software. We're really proud of Red Dog. And literally, Red Dog was named after that dog on the left-hand side. That's Rue. And when the development was being done, Rue was faithfully at the software developer's feet for the hours and hours and hours that it was being done. So that's Rue. Next to Rue is Risa. And they're watching us from someplace at this time. And on the right-hand side of that screen, that's Blue Dog and Red Dog from George Rodrigue, the famous Louisiana artist. So what sort of questions do we have, Kim?
All right, Ralph, I have a question from Donna. She'd like to know, how much does an audit cost an association?
How much does an audit cost? It varies. An association should certainly consider soliciting bids from CPAs. The size of the association, the number of transactions that occur, and I'll state it, the quality of the books, all factor into the price. And so in the Houston area, for normal associations, audits can be anywhere from the $800 range to $2,000. For really large associations, $2,500. The San Antonio CPAs typically are really proud of their work, and so they're going to be up $2,500 to $4,000. There's no reason a CPA in Laredo couldn't be doing the books in Bandera County, because generally if the books are all electronic, as ours are, CPA can do it from anywhere. So thank you, Donna. And a follow-up question.
Ralph, we have another question coming in from Jimmy Burley. His question is in regards to community park improvements. To try to get the MUD or the Water District to apply funds for community park improvements, is it the board that has to come forward, or a combination of the board and the management company?
The management company, so the question is, how do you go about deferring some expenses to another entity, a utility district? One thing to keep in mind is the management company people are most likely not citizens of your district. We're not taxpayers in your district. And the board members, just like you as HOA board members, are citizens of the district. They've been elected and they live in the district or own property in the district. They're going to want the citizens to come in front of them. So it really is a collaborative effort. We as the management company can let you know what's possible. We can tell you how this has been successfully proposed to a utility district before. We can prepare the letters, the documentations, get you on the agenda. But ultimately, when that request is made, it should be the board member or board members who are there saying, let's work together and let's do this. And we can be your support. So great question. It is now past 7 o'clock. I'm sorry, it's now past 8 o'clock. I'm looking at the wrong time over here. And so we're up. If anyone does want to talk later, Kim will give you her cell phone number. So thank you so much for coming. If you have any questions, send emails or whatever else you like. Our next one is next month, and I believe it is practical deed restriction enforcement. So enjoy. Thank you very much.